Please like, share, and subscribe. Wishing you happiness and good luck every day.
So, what if I told you there's a way to find a predictable edge in what looks like the total chaos of the stock market? Yeah, an edge that has nothing to do with guessing the future, but everything to do with accurately measuring the present. Okay, let's dive into this idea, which comes from the work of investor Jeff Augen.
And wow, Augen really sets the stage perfectly here. I mean, think about it. The market is a zero-sum game. For every dollar you win, someone else lost that exact dollar. And when you get into the world of options, the stakes get even higher. It's this super competitive arena where having a real, measurable edge is literally the only thing that separates you from just, well, gambling. So, where do most of us look for that edge? You know, we turn on the TV, we listen to the experts, but here's the thing. There's a huge problem with trying to predict what the market's going to do next. And believe me, there's no better example of this than one of the most dramatic days in modern market history. Okay, picture this. It's October 27th, 1997. The Dow just had its largest point drop in history. I mean, they literally had to halt trading. And that night, if you turned on any financial news channel, it was just wall-to-wall experts explaining exactly why it happened. And they all of them agreed on one thing. Tomorrow is going to be a bloodbath. So what happened the next day? Well, they were completely, totally wrong. The market did open down a bit, but then it just roared back in one of the biggest rallies anyone had ever seen. And the best part? The very same experts who were predicting doom and gloom just hours before were right back on TV, this time explaining, with perfect hindsight, why the surprise rally happened. And this just perfectly illustrates the core problem, doesn't it? Experts are fantastic at telling you why yesterday happened, but their track record for telling you what's going to happen tomorrow, let's just say it's not great. So, okay, if we can't rely on the experts, what about the next logical thing? What about just relying on our own eyes and looking for patterns in the charts?
And that brings us to probably one of the most popular tools out there, technical chart analysis. You know what I'm talking about, looking for trends, support and resistance lines, all that stuff. But what if those patterns we think we see aren't actually real?
All right, you know what? Let's put that theory to a little test. Okay, so I want you to take a look at these two charts. One of them is a real stock from the New York Stock Exchange. The other one, it was made by a computer program just randomly flipping a coin, heads for up, tails for down. So take a second, look closely. Do you see any patterns you recognize? Maybe a breakout over here or what looks like a support line there? Go on, take your best guess. Which one is real?
Okay, got your answer? Well, the truth is, the top chart was generated by a computer flipping a coin. And what's wild is that Jeff Augen says he's shown charts just like this to professional seasoned investors, and not a single one of them could reliably tell the fakes from the real ones. It just goes to show you how easily our brains can get tricked.
And that's the crucial point, right? Our brains are literally hardwired to find patterns, even when there are none to be found. And in a place like the stock market, which is just full of random noise, that makes us super vulnerable to seeing things that just aren't there. So, okay, if we can't trust the experts, and we can't even trust our own eyes, what in the world is left?
Well, this is where we make a really fundamental shift. It's where we stop trying to answer an impossible question, and we start asking a much, much better one. We're going to stop focusing on price and start focusing on something else entirely, volatility.
Think about it. The old question is basically a coin flip, right? Did the price go up or down? It's a guess. But the new question is totally different. It's a measurement. We're asking how big was that move compared to what's normal for this stock. We're not trying to predict where it's going. We're measuring how it's moving. And that is a question we can actually answer with data.
And the main tool we use for this is called standard deviation. Now, I know that sounds kind of technical and scary, but don't worry. Just think of it like a custom-made ruler for every single stock. It measures that stock's normal level of jumpiness. Some stocks are really jumpy, so they have a big ruler. Others are pretty calm, so they have a small one. The whole key is just to measure each stock's daily move against its own special ruler. That's how we can tell if a price move was just normal everyday noise or if it was something really unusual.
And you know what? This simple idea exposes a huge flaw in the standard models that price options. Just take a look at these two stocks right here. According to the typical models, they have the same overall volatility, so they get treated as being equally risky. But just look at them. One is pretty stable, right? The other has these absolutely massive price spikes that are way outside the norm. The standard models, They can't tell the difference. They completely miss this. And that is where the opportunity, the edge, is hiding. Okay, let me show you a real-world example that makes this super clear. You're going to see how this new way of looking at things can uncover these incredibly predictable patterns that are just completely invisible if all you're doing is looking at a price chart.
All right, so what you're looking at here is a price chart for Amazon over about 300 days. And, well, it looks pretty chaotic, right? It's choppy, it's unpredictable. Honestly, it looks a lot like those random charts we saw a minute ago. If your job was to predict the next move just by looking at this, yeah, good luck with that. But now, watch this. Let's look at those exact same 300 days, but through our new lens. Instead of charting the price, we're going to chart the size of the daily moves, measured with our special ruler, the standard deviation. And there it is. A perfectly clear, predictable pattern just jumps right at you. You see those massive spikes? They happen like clockwork, right around every single quarterly earnings report. So if you know that big jump in volatility is coming, you can build a strategy to profit from it, and you don't even have to care if the stock price goes up or down. That, my friends, is the volatility edge.
So, what we've really been talking about here is a total shift in perspective. It's about throwing out the crystal ball that we use to try and predict prices, and instead embracing the much more disciplined mathematical world of statistics.
So let's just boil this all down. What are the big takeaways here? First off, the market is way more random than it looks, and our brains are really good at tricking us into seeing patterns that aren't there. Second, trying to predict which way the price will go is, well, it's incredibly hard. But a stock's volatility, its jumpiness, can actually be very predictable. Third, using that ruler of standard deviation lets us measure that jumpiness and see a hidden story that the price chart completely misses. And finally, and this is so important, this isn't a crystal ball. It's not about predicting the future. It's about giving yourself a real statistical edge in a game where every little advantage counts.
And that really just leaves us with one final thought to chew on. What if the real key to all of this isn't trying to be a fortune teller? What if it's about becoming an expert observer and focusing not on what might happen tomorrow, but on what the data is telling you with certainty right now?
You know, we're always told to trust the experts, right? Especially when it comes to the stock market. But what happens when the experts are consistently wrong? And what if the real key to success isn't about predicting the future, but about seeing the market in a totally different light? So let's start with a story about a massive market crash.
On October 27, 1997, this was the number that flashed across screens everywhere. The Dow Jones Industrial Average plummeted a jaw-dropping 554 points. At the time, it was the biggest point drop in history. You can just imagine the panic. Everyone was glued to the financial news, just desperate for some answers.
And the answers they got, well, they were just completely wrong. The so-called experts on TV not only failed to see the crash coming, but almost every single one of them predicted the market would tank even further the next day. And what actually happened? The market rallied, soaring 337 points. They were dead wrong. It was this incredible failure of conventional wisdom, and really the perfect example of why trying to predict the market is so often a losing game.
So this really begs the question, right? If the people who are paid to know this stuff get it so wrong so often, why is the market so insanely hard to predict? Well, the answer lies in something we can call the market's hidden chaos. It's just part of its fundamental nature.
You see, the market operates on this process called price discovery. And this isn't just random madness. Think of it more like a dynamic, never-ending dance between buyers and sellers, who all have different goals, different strategies, different opinions. This chaos is actually what keeps the market healthy. It's what prevents every little piece of bad news from spiraling into a total catastrophe. To really get a feel for how our brains can get fooled by all this chaos, let's try a little test. On the next slide, you're going to see two stock charts. One is a real chart for a New York Stock Exchange stock. The other was just made by a random number generator. Think you can spot the fake?
Okay, take a good look. A technical analyst might look at these and see all sorts of things. They'd say, oh, see, this one has a clear support line. Or, oh yeah, that one's a classic breakout pattern. Our minds are just wired to find order, to find meaning, even where there isn't any. So, which one do you think is real? The top chart or the bottom one?
If you guessed the bottom chart was Kellogg's, you got it. The top one is completely, totally random. But here's the really wild part. When this same test was given to professional investors, they couldn't reliably spot the fakes either. And that just perfectly illustrates this crucial point. What looks like a predictable pattern to our eyes can often be nothing more than meaningless statistical noise. And the data really backs this up.
Let's look at 2003, for instance. The S&P 500 was up 26%, and the Nasdaq was up a massive 50%. But a portfolio built from the stock picks of the average Wall Street analyst? That was only up about 11%. In most cases, you would have done way better by just buying an index fund and going on vacation.
Okay, so if trying to guess which way the market is going to go is so incredibly difficult, maybe even impossible, what if we've been asking the wrong question this whole time? What if we need a complete shift in how we look at things?
Instead of trying to predict the direction of the price, is it going up or down, what if we focused on analyzing its volatility? That is, how much it moves. This completely changes the game. It stops being a guessing contest and starts being a measurement problem. And volatility is just a simple way of measuring how much a stock's price swings around. It's not about whether it goes up or down. It's all about the size of those swings. And it turns out the size of the moves can often be way more predictable than the direction. In this shift in focus from price to volatility, this is where we can actually start to find a real quantifiable edge. It lets us see these hidden patterns that are completely invisible when you're just staring at a normal price chart.
And the process is actually pretty straightforward. First, you just track the daily price changes. Then, you convert them into a unit called standard deviations, which, don't worry, is just a fancy way of measuring how unusual a move is for that specific stock. And once you chart that data, well, that's when something amazing happens.
Let's check out a real-world example. Here's a standard price chart for Amazon. And to most people, this just looks like a mess, right? It's all over the place, a chaotic jumble of ups and downs with no obvious pattern you could trade. It just looks impossible.
But now, watch what happens when we look at that exact same data through the lens of volatility. All of a sudden, the chaos transforms into this incredibly clear, repeating pattern. See those massive spikes? They happen like clockwork right around Amazon's quarterly earnings releases. It's not random anymore. It becomes a predictable event.
This kind of analysis can even help you tell the difference between stocks that might look pretty similar on the surface. Here we've got two stocks, HOLX and KOSP, with about the same overall volatility. But this chart makes it obvious that HOLX consistently has moves that are 4 times bigger than its typical daily swing. That's a huge anomaly that standard models just can't account for. And those anomalies, well, that's where you find a statistical edge.
So what does this all boil down to? It means shifting away from a philosophy of guesswork and gut feelings, of reacting to news, and moving towards a strategy that's based entirely on data. It's about trading the math, not the prediction. So the core principles are pretty simple. First, stop trying to guess the direction. Instead, start measuring the size of the swings. Then, you find the stocks that have these strange distortions, the ones whose movements don't fit the normal patterns, and you base your trades on that mathematical reality, not on some headline or what an analyst thinks.
At the end of the day, this isn't about getting lucky or making a wild bet on the next big thing. It's a systematic approach. It's designed to find a persistent mathematical edge that can work whether the market is going up, down, or just sideways. It's all about exploiting the fundamental properties of the market itself.
And all of this leaves us with a final big idea to think about. We spend so much time and energy trying to follow the trend, trying to figure out where the market is headed. But what if we've been looking in the wrong place all along? What if the most important signal the market is sending us isn't the trend at all, but the turbulence?
Today, we're going to crack open the code behind one of the most powerful tools in all of finance, the option contract. We're talking about the revolutionary math that took pricing these things from a total guessing game to a legitimate science. Let's dive right in.
I mean, that's really the big question, isn't it? How do you put a hard number, a concrete value, on just the possibility of something happening? You know, the chance that a stock might hit a certain price tomorrow or next week or even next year? Well, that's the puzzle that option pricing tries to solve.
But to really appreciate just how big of a deal this was, we gotta go back in time, back to the early 1970s, a time when finance was, well, kind of flying blind.
Just try to imagine a market with no standard ruler. Seriously, when the Chicago Board Options Exchange officially started trading options in April 1973, there was no single agreed-upon way to price them. It was all gut feelings, little rules of thumb passed down from one trader to the next. It was messy, it was chaotic, it was way more art than science.
So to solve this, people had to start thinking about the market in a completely new way. And the seeds for that big shift were actually planted decades earlier, all the way back in 1900, by a French mathematician named Louis Bachelier. He had this really radical idea about how markets actually move.
He called it the random walk hypothesis. Basically, it says that a stock's past performance tells you absolutely nothing about where it's going to go next. Every single price change is like a brand new coin toss. It's totally independent of the one that came before it. Now, this idea completely flies in the face of looking for predictable patterns on a chart.
Okay, so here's where it gets really interesting. Even if the day-to-day price movements are totally random, the distribution of those changes over time, what we call the returns, is not. They actually tend to bunch up around an average, following this classic bell curve. And this little bit of statistical predictability, that was the key. That was everything.
And this is the final leap. If the percentage returns follow that nice, neat bell curve, then the future stock price itself has to be what's called log normally distributed. All that really means is it can't go below zero, which makes sense, right? And it has this long tail of potentially really high prices. This one single insight is the absolute bedrock of all modern option pricing theory.
So with that foundation finally in place, the stage was set. Someone was about to bring some serious order to all that chaos and, in the process, change the financial world forever. And it happened that very same year, 1973. Two guys, Fisher Black and Myron Scholes, published this landmark paper. And what it did was introduce a really rigorous mathematical framework that could finally put a number on slippery ideas like time and uncertainty. And there it is, the beast. This thing is pretty much the engine of modern finance. For their work on this model, which was later expanded on by Robert Merton, Scholes and Merton were actually awarded the Nobel Prize in 1997. Sadly, Fisher Black had passed away a couple of years earlier, but everyone recognized his massive contribution.
I know, it looks incredibly complex, right? But the best way to think about it is like a recipe. It's got 5 main ingredients. You just need the stock's price right now, the option strike price, how much time is left until it expires, the risk-free interest rate, and the most important and honestly the trickiest ingredient of them all, the stock's volatility.
Okay, so the formula gave us a price. That's huge. But traders also needed a way to manage all the different risks that came along with it, in real time. And this led to the creation of a super practical toolkit that we now call the Greeks.
Think of the Greeks like the dashboard in your car. That's the perfect analogy. Each one is like a different gauge that's measuring a specific kind of risk. It lets a trader see exactly how their position is going to react when the market starts moving around.
So first up, you've got delta. This is your speedometer. It just tells you how much your option's price should move for every $1 change in the stock. So, a delta of 0.50 means your option's going to gain or lose about 50 cents every time the stock moves a buck. Pretty straightforward.
But then you've got gamma. If delta is your speed, gamma is your acceleration. It measures how fast your delta is changing. And a high gamma means your risk exposure can just explode or collapse with even tiny moves in the stock. That makes it one of the most critical things to watch.
And this right here, this chart shows you why traders are always worried about gamma. Check out this dangerous dance between the two as an option gets closer to expiring. You can see that for an out-of-the-money option, its delta is falling, but its gamma, that potential for explosive change, is just spiking. This is where things can get out of control fast.
And then there's theta. Think of it as the fuel your option is constantly burning, or like a built-in countdown clock. Every single day that passes, your option loses a tiny bit of value just because time is running out. This makes theta the absolute enemy of the person who buys an option and the best friend of the person who sells it.
But, and there's always a but, as revolutionary as the Black-Scholes model was, and believe me, it was a game changer, it's not perfect. Like any model that tries to predict the real world, it's got some flaws.
There's that great saying, the map is not the territory. And that's exactly what's going on here. These financial models are incredibly powerful maps of reality, but they are not reality itself. And the Black-Scholes model has one particularly famous weak spot. The model's biggest Achilles heel, the one thing everyone points to, is one of its main assumptions. It assumes that volatility, that key ingredient sigma, stays constant. But anyone who's watched a market for more than 5 minutes knows that's just not true. Volatility is anything but stable. It's whipping around all the time.
So naturally, that flaw led people to develop other ways of doing things, like what we call binomial tree models.
See, instead of one single flowing formula, these models break time down into little individual steps, and this lets them account for changing volatility, which creates a much more customized and, frankly, a more realistic pricing model for how the markets really are.
Which kind of leaves us with one final thought. We've seen how this powerful formula brought logic and order to the markets, but we've also seen where it falls short. So if every single model is just an imperfect map of the world, where does the real edge in trading come from? Is it about finding a more perfect model? Or is it about the skill and the intuition of the person who knows exactly how and when to use the map they've got?
All right, let's get into it. Today, we're putting on our detective hats because we're going after the single most mysterious variable in all of finance, volatility. You can think of it as the ghost in the machine of option pricing, and our job, right now, is to track it down.
And this really is the fundamental question, isn't it? It's what every single options trader has to wrestle with. See, when you buy an option, you're not just betting on which way a stock will go. You're buying a piece of its potential future movement. But how on earth do you put a price tag on that?
Think of an options price as coming out of a complex pricing engine. You've got 5 key inputs you feed into it. Now, 4 of them are simple, known facts you can look up in a second. How much time is left, the stock's price right now, the strike price, and the current interest rate. Easy. But that 5th one, volatility, well, that's not a fact at all. It's a forecast. It's an educated guess. And it's that one single variable that turns all of this from simple math into a full-blown investigation.
So, let's officially begin our investigation. And believe me, the stakes are incredibly high, because getting volatility right or getting it wrong doesn't just nudge the price a little. Oh no, it changes absolutely everything.
Get a load of this number. This really gets to the heart of why volatility is so powerful. The relationship here isn't one-to-one. If you take an option and just double its expected volatility input, the fair price can explode by over 460%. And you know what? Changes like that aren't even that rare. This just goes to show you, understanding volatility isn't just an edge, it is the entire game.
So, where does a volatility detective even start? Well, you begin by looking at the 2 main forms it takes. Think of these as the very first clues that help us start building a profile of a stock's real behavior.
Okay, so on one side, you have historical volatility. The best way to think about this is like the cold, hard case file. It's just the facts, calculated from past price movements. It's a perfect record of what a stock has done. But then, on the other side, you have implied volatility. This is the market buzz, the word on the street. It's the volatility that's already baked into current option prices, and it represents what everyone thinks the stock might do. A lot of the time, they're pretty similar, but when they're not, that's where a good detective finds an opportunity.
Now, to make any sense of that case file, a trader needs a specialized toolkit. We're not just guessing here. These are real analytical methods for digging into a stock's past to find patterns, clues, anything that tells us about its true character.
So when we talk about volatility as a number, what are we actually measuring? Well, in simple terms, it represents a 1 standard deviation price change over a year. So, for example, if you have a $100 stock with 30% volatility, the models are basically saying there's a 68% chance it'll be trading somewhere between $70 and $130 a year from now. It's just a standardized way to measure how jumpy a stock is.
Okay, time to look at some real evidence. Here we've got Apple's stock price down on the bottom and its volatility charted up top. The first thing you should notice is that they don't always move in sync. Not at all. The price can be climbing nice and steady while volatility is snoozing, or the price can be going nowhere, totally flat, while volatility is spiking like crazy. They are 2 different, though related, stories.
Now, a really key tool for our detective is something called the sliding window. Basically, we can change our lens. Look at the chart on the left. We're using a 90-day window, and it smooths everything out, giving us that nice long-term trend. But on the right, we've switched to a 10-day window. It's much more sensitive, way more noisy, and it captures every little shock to the system. Now, neither one is right or wrong. They just give you totally different perspectives on the exact same evidence. It's like zooming in and zooming out.
Okay, this is where we start building a much more complete picture. See, advanced analysis goes way beyond just a single number. It's about actually profiling a stock's personality, looking for its unique tells, its habits, and any recurring patterns of behavior, just like a real detective would profile a suspect.
Our first clue comes from the price spike chart. Now, let's be clear, this is not a price chart. Each one of those bars is a single day's price move, but it's measured in standard deviations. Now, according to the standard models, a 5 standard deviation move should basically never, ever happen. Yet for this stock, Cephalon, we see it happening multiple times in just 1 year. This chart reveals a personality that is prone to massive, unpredictable outbursts. This thing has a temper.
Our second clue, we're looking for cycles. Take a look at this chart for ExxonMobil. You can clearly see a repeating pattern, right? A rhythm of high volatility followed by low volatility. This is often tied to things in the real world, like seasons or quarterly industry reports. For a trader, being able to spot these predictable mood swings can be an absolutely invaluable piece of intelligence.
And our third clue is a really interesting phenomenon called the volatility smile. What you're looking at here is a chart that plots implied volatility against different option strike prices for Apple. Now, if the market thought a huge rally was just as likely as a huge crash, this line would be flat. But it's not, is it? It's skewed into this smile, or maybe more of a smirk. See how the volatility and therefore the options price gets much higher for the lower strike prices over on the left? That shape is a direct visualization of fear. The market is collectively saying we are willing to pay way more for protection against a crash than we are for a lottery ticket on a massive rally.
And what's really fascinating is that when you put all of this together, you realize every single stock has a unique volatility fingerprint. Just look at this table. It's like a police lineup of different stocks. You've got a stock like CRL, which is relatively tame. Its long-term volatility hovering around 29%. But then you've got MYOG, an absolute wild card whose volatility has spiked as high as 184%. This is exactly why using just a single number for volatility never, ever tells you the whole story.
So, after gathering all this evidence, the historical data, the spikes, the cycles, the smile, how does our detective finally crack the case and actually find a trading opportunity?
Well, the goal isn't to be a fortune teller. It's not about predicting the future with 100% certainty. It's about developing a deep, deep understanding of a stock's true character, and then comparing that to what the market is currently pricing in. The whole objective is to find those moments when an options price seems totally out of line with its underlying historical behavior. And that gap, the space between your assessment of fair volatility and the market's current implied volatility, that is the trading edge.
And you know, this quote from our source material just sums it up perfectly. The principal goal of an options trader is to arbitrage subtle differences between implied and fair volatility by structuring positions that capitalize on those discrepancies. It's all right there. You're not just trading the stock, you're trading the market's expectation versus your own detailed analysis.
Which kind of leaves us with one final question to think about. After all this analysis, is volatility really just a statistical input for a pricing model, or is it something more? Is it maybe a way to actually see and to measure the emotional state of the entire market, all of its hopes, its anxieties, its fear, and its greed, all condensed down into a single, fluctuating number? Now that's something to think about.
Okay, let's dive into the wild world of options trading. It's a place where just picking a stock's direction is only like half the battle. And sometimes it's the half that doesn't even matter.
So get this. How is it even possible to be totally right? You predict a stock is going to go up, you buy the option that's supposed to make you money from that move, and you still end up losing. It sounds like it breaks the rules of logic, but today we're going to unravel exactly how this happens. And right here, this is our central mystery, laid out in black and white. This is real data from a trade on an oil services fund, OIH. Over just a few days, you can see the stock price itself is climbing. It goes from around 133 up to 135. But look at the price of the call option. It's actually dropping. How is that possible?
So we're going to treat this like a detective case. Our mission is to solve the puzzle of this impossible losing trade. And along the way, we're going to uncover these hidden forces that were working against the trader. Forces that are out there in the market every single day.
Our very first clue is something I like to call the toll booth effect. Just imagine that every time you want to get onto the options trading highway, you got to pay a small fee to get on, and you got to pay another one to get off. It's this tiny little price of admission that's always there, whether you realize it or not.
Now that toll booth has an official name. It's the bid-ask spread. It's just that little gap between what buyers are willing to pay, the bid, and what sellers are asking for. So when you buy, you always pay that slightly higher ask price, and when you sell, you get that slightly lower bid price. That difference is an instant baked-in cost on every single trade you make.
And to see just how punishing this spread can be, let's look at a trade that has a few moving parts. Now don't worry about the strategy itself. It's called a condor, but we're just using it to show how this hidden cost can pile up really, really fast.
So a trader puts on this multi-part trade with Sears options, and based on the prices, they expect to collect a credit of exactly $1. That's their potential profit. Simple enough.
But here's the kicker. If that same trader tried to close the whole position out, just a moment later, it would cost them $1.50. Why? Well, because now they have to pay that toll, that bid-ask spread, on all 4 parts of the trade just to get out.
So think about what that means. The literal moment the trade was opened, that trader was already staring at an immediate 50% paper loss. Not because the stock moved against them, not because they were wrong, purely because of that toll booth effect. That is a huge hole to climb out of before you can even think about making a profit.
Okay, so the spread is a constant hurdle, for sure. But it's not the main culprit in our OIH mystery. For that, we need our second clue, and it's a big one. The volatility wild card. The best way to think of implied volatility is like the market's mood ring. It's not about where the stock is now, it's all about how much everyone expects it to move around in the future.
And this is absolutely crucial. When you buy an option, you're not just betting on direction. You're also buying that expectation, that mood. So, if that expectation suddenly collapses, if the market decides the stock is actually going to be kind of boring, the value of your option can get totally crushed, even if the stock moves exactly the way you wanted it to.
And here it is. We're connecting it all back to our case. Look at the data again. While the OIH stock price was climbing, just like the trader predicted, the implied volatility absolutely plummeted, from over 33% down to 28%. That drop in expectation was so powerful, it completely canceled out the gains from the stock's move, and it's why the option's value went down. This right here is the smoking gun.
Now, just to show you how insane these volatility swings can get, check out this chart for Google. In the days leading up to a big earnings report, you can see the market's anxiety just goes through the roof. Implied volatility for the options more than tripled, from around 40% all the way to 130%. And then, of course, once the news is out, that volatility can collapse right back down in an instant, just vaporizing the value of those options. It's a phenomenon traders call volatility crush.
All right, we're almost there. Our final 2 clues are a bit more subtle, but they really help complete the picture. We'll call them market sentiment, the overall mood, and market traffic, which is just about how many people are actually buying and selling.
So first up, sentiment. Sometimes the market just gets so bullish on a stock that it starts to price the options a little unevenly. Like in this example with Goldman Sachs, the volatility being priced into the calls, the bullish bets, was 29%, but for the puts, it was only 24%. It's like an unbalanced scale, where one type of bet becomes more expensive just because it's the popular one.
And our last clue is liquidity. The easiest way to wrap your head around this is to go back to our highway analogy. Think of it as traffic. When there are tons of buyers and sellers, high traffic, it's super easy to get in and out of a trade at a good price. But when that road is empty, well, things get a lot harder and a lot more expensive.
This table makes the difference crystal clear. Look at Dell. Millions of shares traded, thousands of option contracts changing hands. That's an 8-lane superhighway. Now look down at FFH. Really low share volume. And on this day, literally 0 call options were traded. Trying to trade that is like being on a deserted country road. It's tough, and you're probably going to face a much wider bid-ask spread, a much bigger toll booth fee.
And this is what that traffic actually looks like to a trader. It's called the Level 2 queue, or the order book. It shows you all the orders just sitting there waiting to be filled, the exact number of contracts people are willing to buy and sell at every single price. This depth is what tells you if the highway is busy or if it's totally empty.
Okay, we have all our clues. The toll booth spread, the volatility wildcard, the market sentiment, and the amount of traffic. Let's put it all together and officially solve the case of the impossible losing trade.
So why did the OIH trader lose? They got the direction right, which feels like it should be enough, but a perfect storm of other factors works against them. The collapse in implied volatility was the primary killer. It just sucked the value right out of their option. Then, on top of that, the bid-ask spread meant they started the trade already in a hole.
So they won the battle on direction, but lost the war against these other more powerful market forces.
What this all really boils down to is a much, much deeper way of thinking about risk. See, when you're trading options, you're not just dealing with the price of a stock. You're dealing with the price of time, the price of expectation, and the price of just getting your trade done.
And this quote from our source material just absolutely nails it. Volatility, spreads, liquidity, these aren't minor details you can ignore. They are fundamental forces, and even tiny shifts in any of them can completely flip the outcome of your trade. The key is to see the entire landscape.
So I'll leave you with this question to think about. The next time you're looking at a potential investment, and it could be anything, not just options, ask yourself, am I only focused on which way I think the price is going to go, or am I taking a step back to see all the other hidden costs and forces at play? Am I really seeing the full price of risk?
So a lot of people think of an option as just a simple bet on a stock's future price. But you know what? That's kind of like only watching the last 5 minutes of a movie and thinking you know the whole story. Today, we're going to pull back the curtain on the hidden life of an option trade, and you're going to see why the journey is often way more important than the destination. Let's get into it. And this really gets right to the heart of it, that classic buy and hold idea where you just set it and forget it until expiration day. It's a massive oversimplification. Honestly, more often than not, it's a losing strategy, and we're about to find out exactly why. All right, so first up, we need to completely dismantle what I call the expiration date illusion, this idea that an option story only really matters on its very last day. Yeah, this is what most people think, right? You buy a call, you hope the stock goes up. You buy a put, you hope it goes down. And you figure you make money if the stock is past your strike price when the clock runs out. And look, while that's technically true, it misses almost the entire picture. The most exciting parts, actually. This right here, this is the core of what we're talking about. On one side, you've got that static view, a simple bet focused on one single day in the future. But the dynamic reality, that's where the real action is. It's about the entire life of the trade. It's about asking, how are time and volatility affecting my options value right now? It totally transforms a simple bet into an active, hands-on management process. To really see just how wrong that static view can be, let's jump into a real-world example. We're going to watch a trade's wild journey unfold, and it's a bumpy one. Okay, so here we're looking at the price of Apple stock over about 100 days. You can see it goes up, it comes back down. It's a bit of a roller coaster, but nothing totally crazy, right? Looks pretty standard. Now just hold that thought. Because this is the price of an $80 call option on that very same stock over the very same 100 days. And whoa! Suddenly, the picture looks completely different, doesn't it? Look at that massive dramatic spike in the options price early on. It's telling a much, much wilder story than the stock chart alone. Now here's where it gets really interesting. The timing. So a trader buys this call for $4.25, and just 26 days into the trade, as the stock price is just starting to climb, the options price explodes to $9.20. That's more than double the initial investment. The profit was right there for the taking, long before expiration. So what happened to the trader who just held on, the one who believed only the expiration date mattered? Well, they would have lost 100%. Everything. And this is the whole point. The trade was a massive winner, up over 100% on day 26. But by the time expiration rolled around, it was a total loss. The opportunity wasn't at the end of the story. It was smack in the middle of that wild journey. This is exactly why focusing only on expiration is just an illusion. So what in the world causes these huge swings in an option's value that don't always line up with where the stock ends up? Well, to get that, we need to learn how to decode the underlying stock's true personality. And the key lies in a concept called price spikes. Now, these aren't just big price moves. They are statistically unusual changes. By actually measuring these spikes, we can see a stock's hidden tendencies. Its personality for making these sharp, unexpected moves that a lot of the standard option pricing models just miss. So let's check out Apple's personality profile over 500 days. Every single bar here is a price spike. You see it? The spikes above that zero line, those are the upward moves. They are way larger and happen much more often than the downward spikes below it. This reveals that Apple has a hidden tendency for explosive, almost violent moves to the upside. And knowing this personality has huge consequences. I mean, think about it. For someone selling options on Apple, selling calls becomes incredibly risky. Why? Because they're facing those frequent, massive upward spikes that just are not fully priced into the option. They're seriously undercompensated for taking on that risk. Selling puts, though, that's a whole different story because the downward moves are much more orderly and predictable.
Okay, so this brings us to a really major shift in thinking. What if instead of betting on which direction a stock will go, you could just bet that it's going to move a lot? What if you could trade the shakes themselves?
Well, that is exactly what a long straddle is designed to do. By buying both a call and a put at the very same strike price, you're not really betting on direction anymore. You're betting on volatility. You win if the stock makes a big move, and it doesn't matter if it's up or down. And using this strategy really depends entirely on the stock's personality. For example, a stock like USNA has these enormous, pretty predictable spikes right around earnings. But then you look at a stock like MHS, and its spikes are smaller, but they're way more frequent and totally random. See? Two very different personalities that need two completely different strategies to profit from their shakes. Let's actually see this in action with MHS. So on October 17th, a trader buys a straddle for $6,500. A few days later, the stock spikes down. Now, if you were a simple call buyer, you'd be totally wiped out. But because this trader owned both a put and a call, the position's value jumped to $9,200. That's a 42% profit. They successfully traded the shake, not the direction. Okay, let's pull all of these ideas together into what we can call the active trader's mindset. This is really the new way of thinking you need to navigate the dynamic, fast-moving reality of options. So what are the big takeaways here? First, you got to focus on trading the option itself, not just the stock underneath it. Second, you have to remember that the option's journey through time, that's where the opportunities are, often much more than at expiration. Third, a stock's price spike history is like its fingerprint. It reveals its unique personality and all its hidden risks. And finally, all of this demands active management. You have to understand and adjust for how sensitive your position is to price changes as the trade evolves.
You know, the source material just puts it perfectly. If your options value changes dramatically and you do nothing, just close your eyes and hope it'll all work out by expiration day, you're not managing a trade anymore. You are actively choosing to gamble.
And that really brings us to our final question, and it's one you should be asking yourself on every single trade you make. Are you actively managing the dynamic life of your trade, or are you just gambling on a future outcome? The answer to that? Well, it makes all the difference. Thanks for joining me.
All right, welcome to The Explainer. Today we're diving into what's called the complexity trap in options trading. You know, that idea that adding more and more layers to a trade makes it safer? Well, we're going to see why that's not just wrong, but why it can actually blow up in your face in ways you would never, ever expect.
So let's just jump right in with this quote. It really gets to the core of this really dangerous myth in trading, right? The idea that these super complex strategies are somehow safer. But our source material here, it argues the complete opposite. It's saying that what you think is a safety net, it's actually more like walking a tightrope, but you don't even realize there's nothing below you.
And here's the core of the problem. When it comes to options, complexity isn't just, 1 + 1 = 2. It's exponential. So you add just one new thing, like, say, a different expiration date, and you haven't just added one more thing to track. No way. You've created this whole spiderweb of new interconnected risks. And the scary part is, a lot of these new risks, these new points where everything can just fall apart, they're basically impossible to see coming.
Okay, Section 1. When time is a factor. We're going to look at the hidden dangers of calendar and diagonal spreads. So let's put this whole idea of exponential risk to the test. Let's just add just one new variable to the mix, time. This right here is where you really start to see the cracks form in that illusion of a perfectly hedged trade.
So, first up, what even is a diagonal spread? Well, think of it this way. It's a trade where you're messing with not just different strike prices, but different expiration dates too. And that changes everything. See, now you're not just betting on if the stock's going to move, you're betting on when it's going to move. And believe me, that when introduces a whole new world of hurt.
Okay, and this is where it gets really interesting. Take a look at this. It's a real trade scenario. And check it out. The trader was totally right. They bet the stock would go up, and it did. It went from $71 to $79. You'd think that's a winning trade, right? Well, because of the timing, being right about the direction, it just wasn't enough. And boom, there's the result, a loss of $175 per contract. So, what the heck happened? Well, it's simple. The option that was supposed to make all the money, it was so close to expiring that it literally ran out of time to actually gain any value from the stock's move. And at the same time, the other side of the trade, the short option, was just sitting there, turning into a bigger and bigger problem. The so-called hedge didn't just fail to work, it completely backfired.
So this really just hammers the point home, doesn't it? You have the exact same trade setup. If the stock moves fast, you make money. If the stock moves a little bit slower, even in the exact right direction, you lose money. It's crazy. In these kinds of trades, time isn't just ticking away in the background, no. It's an active player in the game, and it can absolutely work against you.
All right, next up, playing the numbers game. We're going to look at ratio spreads and asymmetrical risk. So, we've seen how just adding time to the mix can get messy. Now, let's add another layer of complexity. What happens when you're not trading one option for one, but you're using different numbers of them? That's where we get into something called ratio spreads.
So the whole idea behind a ratio spread is to make money when a stock pretty much stays put. Trades within a specific range. You might be long, say, 10 contracts, but short 20 contracts. And on paper, it looks great. It seems like this really safe, market-neutral play that just kind of quietly makes you money as options lose value over time. It's supposed to be predictable. And you know what? Sometimes, when all the stars align, this strategy works perfectly. It works like a charm. Here's an example of a trade on Sears. And back then, Sears was about as exciting as watching paint dry, a really stable stock. And look at that. The value of the position just climbs and climbs, all the way to $4,400, just because the stock did exactly what everyone expected it to do. This is the textbook case. This is what you hope for.
Okay, Section 3, why volatility changes everything. We're comparing the stable strategy versus the unpredictable market. So, but. There's always a but, isn't there? What happens when the stock isn't stable? What happens when it's not boring old Sears, but something wild, something unpredictable? Well, this is when that complexity trap we've been talking about springs shut, and it does it with brutal force.
So, let's just quickly recap. That Sears trade, it worked for one simple reason. The stock was stable, it was predictable. The money was made because the options just decayed over time exactly like the plan said they would. The strategy worked because the market was nice and calm.
But that leads to the million-dollar question, doesn't it? The one that every single trader needs to ask themselves before they put on one of these complex trades. What happens if the market stops being so calm? What happens when it stops playing nice? What happens when reality decides to show up?
Well, the answer is chaos. Absolute chaos. Look at this. It's the exact same trade structure we saw before, but this time it's on Apple, a much, much more volatile stock. And you could see it was working at first. It was making a little money, and then, bam, a sudden price spike and the trade craters, losing over $2,600 in just 2 days. The exact same strategy that was so safe and predictable on a stable stock, it completely disintegrated on a volatile one.
And we're not talking about your everyday market wiggles here. Look at this chart. These were massive, freak events, what a statistician would call a 4 standard deviation move. I mean, these are things that are just not supposed to happen. They were so extreme, so violent, that they just completely overwhelmed any of the trade's supposed protections. This is a textbook example of a pretty theory running headfirst into the brick wall of market reality.
So here's the really crucial point, the thing you have to understand. That hedged, complex position, it didn't just fail, it completely broke down. And it transformed. It stopped being a sophisticated spread, and it just became a simple, incredibly high-risk bet against a stock that was shooting for the moon. All that complexity didn't protect the trader at all. All it did was disguise the real massive risk that was hiding underneath, right up until it was way too late.
Section 4, your management playbook. The subtitle says it all. The only true hedge is a solid plan. So if these fancy, complex structures can't actually protect you, then what can? What are you supposed to do? Well, our source material is really clear about this. Success isn't about finding the perfect, magical trade setup. It's all about how you actively manage the trade once you're in it.
Honestly, if you take one thing away from this whole explainer, let it be this. Stop searching for the perfect trade structure. It doesn't exist. Instead, focus all that energy on building a bulletproof management plan. And it really comes down to these 3 pillars.
1. Know your goals before you even click the button. 2. Define your uncle point. Decide exactly where you're getting out to protect your capital, and stick to it. No exceptions. And 3. Plan for things to go wrong. Figure out how you're going to react before the chaos hits. Because at the end of the day, a disciplined plan is the only thing that's going to protect you.
So when you boil it all down, the message from our source material is pretty stark. Complexity in trading? It's not a feature, it's a bug. It's a vulnerability that you have to constantly watch and manage with a rock-solid plan. Which leaves us with one final question for you to think about. Is the potential reward from one of these high-wire trades really, truly worth the risk if you don't have that rigorous plan in place to manage it?
Every single quarter, it's the same story. Public companies get ready to announce their earnings, and you can practically feel the entire market holding its breath. But what if the real play isn't in the news itself? What if the opportunity is actually in the totally predictable cycle of fear and relief that happens right before and right after? Well, today, we're going to break down exactly how you can trade that cycle. It sounds kind of crazy, right? How can you profit from something that hasn't even occurred? But the analysis we're digging into today suggests that when it comes to earnings, the market has these predictable little quirks, these tradable distortions. And the key isn't about guessing what the news will be, not at all. It's about understanding how the market reacts to just the idea of the unknown. All right, so here's our game plan. First, we'll unpack what this earnings distortion actually is. Then we'll look at two strategies that are basically polar opposites, the volatility climb and the volatility crush. And finally, we'll wrap it all up with the big takeaways and, of course, the risks involved. So what on earth is this distortion? Well, you can think of it like a battle. On one side, you have the time leading up to an earnings report. Uncertainty is through the roof, right? That makes the price of options inflate like crazy. Then on the other side, the report drops. All that uncertainty just vanishes, and the price of those same options completely collapses. It's this predictable rise and fall that creates the anomaly we're going to explore. Now, to really get this, there's one term you absolutely have to know: implied volatility. The easiest way to think about it is as the market's anxiety meter. It's not guessing where the stock will go, up or down. It's guessing how much of a roller coaster ride it's going to be. So right before earnings, everyone expects a huge move. So that anxiety meter, implied volatility, gets cranked way, way up. And here's the kicker from all the research. The market, well, it tends to get a little carried away. It's like everyone is buying disaster insurance. To protect themselves from some massive, unexpected price spike, traders are willing to overpay for options. And it's this overpricing, which is really just driven by good old-fashioned fear, that sets the stage for the two very different opportunities we're about to look at. All right, let's dive into our first strategy, the volatility climb. This one is all about that period before the announcement. You know, when all that fear and anxiety are building to a fever pitch. The goal here is actually pretty simple. You're not placing a bet on the earnings report itself. Nope. You are betting on the increase in anxiety in the days leading up to it. The play is to buy options when that anxiety, that implied volatility, is still pretty low, and then you aim to sell them right at the peak, just before the news actually drops. Okay, this slide just shows the whole concept so clearly. This is some old data for Google options from back in 2006. Just look at that volatility column. 11 days before the announcement, it's sitting at 0.45. But as the days remaining tick down, just watch it go. It climbs and climbs, hitting 1.30 only 2 days out. It almost tripled, and for no other reason than pure anticipation. And here's the payoff. This chart tracks a sample trade that was riding that wave of rising volatility. So the position starts out worth about $4,000. But as that volatility climbed, look what happened. The value just swelled, peaking at over $17,000 right before earnings. Now, the stock price did move a little, sure, but the real engine here was that skyrocketing volatility. I mean, get this. The research points out this incredible little detail. In the first 8 days of that trade, the position gained 25%. And during that time, the actual stock price had barely moved at all. It's just proof positive that the profit here was coming from the rising price of uncertainty, not from predicting the stock's direction. So you can probably guess timing is everything. This quote from the source really drives it home. It mentions a similar trade on Apple stock that returned an incredible 280% if it was closed before the earnings announcement. But if you held on through the news, it would have flipped to a 100% loss as soon as that volatility collapsed. The goal is to sell at the absolute peak of fear, not to wait for the news. And this lays out the other half of our story just perfectly. Where the climb is all about buying low and selling high on volatility, the crush is the exact opposite move. You sell when fear is at its peak, and you profit from that inevitable collapse right after the news is out. Okay, let's talk about strategy number 2, the volatility crush. This is where you take the other side of that bet, and you're focusing on that moment right after the earnings news comes out, and all that uncertainty just disappears into thin air. The logic here is really straightforward. You're basically becoming the insurance seller. Right before the announcement, when implied volatility is through the roof, you sell those super overpriced options to other people. Then, once the earnings numbers are out, the reason for all that anxiety is just gone. Volatility plummets, the option prices collapse, and you can buy them back for a fraction of what you sold them for. But, and this is a huge but, we have to be crystal clear here. This strategy is absolutely not for the faint of heart. Selling options like this can expose a trader to potentially unlimited risk. And why is that? Because you're making a bet that the stock's actual price move won't be as big as the market fears it will be. But sometimes it is. This chart of Yahoo's stock from back in the day shows you exactly what that risk looks like. See all those little tiny bars clustered around the zero line? That's just normal everyday market noise. But those massive spikes, the ones that shoot way up or way down, yeah, those are pretty much all earnings announcements. With this strategy, you are literally standing in front of a potential explosion, betting it won't be big enough to hurt you. And just look at that single biggest spike on the chart, a negative 13.3 standard deviation event. I mean, from a statistical point of view, that is a move that is so rare it's barely supposed to happen, ever. This is the black swan risk that sellers are getting paid to take on. The market isn't crazy for pricing in all that fear. It has a very long memory for days like this one. Okay, so let's pull this all together and go over the key takeaways from this whole earnings cycle. So really, what we have are two sides of the exact same coin. The climb is where you buy options early to ride that wave of building anxiety, and you make sure to get out right at the top. And then the crush is where you sell those same overpriced options at the peak, and then you profit from the sigh of relief after the news is out. Both strategies depend entirely on pinpoint timing around that earnings event. And that really brings us to the single most important idea in this entire explainer. The opportunity here isn't about being some kind of fortune teller who knows what a company's earnings are going to be. No way. It's about being a strategist who understands the predictable cyclical dance of market fear and uncertainty, of volatility itself. Which leaves us with one last big question to chew on. The data shows this pattern is persistent. It happens over and over again. So, if markets are supposed to be so efficient and smart, why does this keep happening every single quarter? You'd think the market would just price it away. But maybe, just maybe, it tells us that even in the most efficient markets, the very human emotions of fear and greed, which play out on schedule 4 times a year, always create an opening for those who know where to look. You know, we all kind of think of the stock market as this chaotic, totally unpredictable ocean of random price movements. But what if I told you that just beneath the surface, there are these powerful, predictable currents? Well, today, we're diving deep into one of the most fascinating ones, the options expiration cycle. Okay, so let me start with a question for you. Have you ever been watching a stock on a specific Friday and it just gets stuck? I mean, it just gravitates towards one single price and kind of hovers there for hours, completely ignoring all the other news and noise of the day. And no, it's not just a coincidence. It's a real phenomenon known as pinning. All right, first up, the mystery of the pin. We're going to look at this strangely predictable anomaly and try to figure out the hidden machinery that makes it tick. It's like someone flips a switch on an invisible magnet. Seriously, on these expiration Fridays, certain stocks just start drifting toward a particular price, what we call the strike price, and they just hover. It's this powerful force that, for a little while, just overrides all the usual market chaos. So, what in the world is this magnet? Let's get into it and decode the forces that are really behind this whole pinning effect. So, the culprit? It's not some kind of market magic. It's all about mechanics. This incredible force comes from thousands of options traders. We're talking especially the big institutions, all unwinding these massive, complex positions at the exact same time. All that activity creates this immense gravitational pull on the stock's price. Okay, so to really get this, we got to do a super quick refresh on what an option is. It's just a contract, right? It gives the owner the right, but not the obligation, that's key, to buy or sell a stock at a set strike price by a certain date. That strike price and that expiration date, those are the two crucial ingredients here.
Now, the engine, the real muscle behind the pin, is a strategy called delta hedging. See, the market makers who sell all these options, they don't want to gamble. They're in the business of managing risk. So as a stock price moves around, they are constantly buying or selling the actual stock to keep their books neutral. Well, when you have thousands and thousands of options all set to expire at one single strike price, all that hedging creates a powerful pull, literally dragging the stock price right to that number.
And we're not talking about some tiny little market quirk here. This is a big deal. The pinning effect is so powerful that on an average expiration day, it can cause an aggregate shift of about $9 billion in a company's market value. I mean, that's the sheer scale of the force we're dealing with.
Now for the fun part, a real-world example. We're going to rewind the clock to March 17th, 2006, and watch this pinning effect happen minute by minute to Google's stock. Okay, look at this chart with me. Google opens, it dips down a bit, but then, right around 11 a.m., it starts this rapid climb straight towards the $340 strike price. You can see it. It actually overshoots for a second at 11:40, but then it gets yanked right back and spends the rest of the day just trading in this super tight range right below $340. The magnet is on, and it is holding that price in place. And at the exact same time this is happening, watch this. Volatility just collapses. This chart shows the implied volatility for those $340 options. As soon as the stock gets pinned, all the uncertainty, and the options value right along with it, just evaporates. It plummets all the way down towards zero. So what does this mean for traders? Well, it has a direct and pretty brutal financial impact. For instance, a straddle, which is a common trade that basically bets on a big price move in either direction, starts the day worth over $7. But as that pin takes hold and volatility just dies, its volume melts away like an ice cube, becoming pretty much worthless by the end of the day. So, naturally, whenever you see a predictable pattern like this, you just know there are traders trying to figure out how to make money from it. So how exactly do people trade this anomaly? Well, traders use these specific strategies that are designed to profit from this rapid decay in value. So on this particular day with Google, a play called a ratio spread, which makes money if the stock stays put, returned 46% in a single day. Other strategies, like calendar spreads, also saw really impressive returns just by betting against that volatility. But, and this is a huge but, this is absolutely not a free lunch. Even when you're trading a predictable pattern, risk management is everything. Getting overconfident, as the source material warns, is always a mistake. If that pin breaks, you have to get out, and you have to get out fast. Because the pin can, and it absolutely does, fail. The magnet really only works under certain conditions. It's best when a stock is trading pretty calmly near a strike price that has a ton of open interest, which just means a lot of active options contracts. But if some big news event pushes the stock into a whole new price range where there isn't much open interest, that magnetic force, it just vanishes. And here's the proof. This is exactly what happened to Google just 1 month later. An earnings announcement sent the stock soaring. Look at this chart. It's the complete opposite of the last one we saw. The price is wild, it's volatile, it's totally unpredictable. It blew right past all the key strike prices, and the pinning effect, it just completely failed to show up. But you see, the pin on that Friday, that's really only half the story. There's another, equally powerful force at play during the entire final week of the expiration cycle. The countdown is on, and this one is all about time. This second force is all about accelerating time decay. I mean, think about it. The market's only open for 6.5 hours a day. It's closed for 17.5. As you get closer and closer to expiration, those hours when the market is closed become a massive, dominant factor in how an option loses its value. Now, this chart is just incredible. It really tells the story. It shows how much of an option's value disappears during trading hours, that's the light gray bars, versus while the market is closed, the dark gray ones. Just look at Thursday. A huge chunk of the option's value just vanishes overnight, while absolutely no trading is even happening. It's crazy. So what you get during this final week is this intense tug of war. Time decay is accelerating like a runaway train. Buyers know this, so they start lowering what they're willing to pay. But sellers, they know it too, and they're also worried about some surprise news dropping overnight, so they try to keep their prices up.
The result is just a chaotic week with wider price spreads and these big, wild swings in volatility. Okay, so let's pull back. What's the big picture here? Let's talk about what these forces, the ones hiding in plain sight, really tell us about the market itself. The key takeaway, the big idea, is this. The market isn't just some random walk. Its own rigid structure, like having a fixed expiration date every single month, interacts with the cold, hard math of option pricing to create predictable patterns, predictable distortions. These are forces that are hiding in plain sight, and you just can't see them if you're only looking at the standard models. And that really leaves us with one final fascinating thought. If something as simple and mundane as the market's calendar can create a gravitational pull strong enough to shift billions of dollars and pin a stock in place, it really makes you wonder, what other powerful, invisible forces are still out there, just hiding in plain sight?
All right, let's jump right in. Have you ever really wondered how professional traders get a real, sustainable edge in the market? You know, we hear all the time about secret indicators or some magic formula, but today we're going to look at how the pros actually do it by building sophisticated tool sets that give them a genuine advantage.
Okay, so first things first, let's get one hard truth out of the way. The markets are incredibly complex, and they are always changing. You've got inflation, interest rates, global events, and because of this constant change, any single fixed trading system is pretty much guaranteed to fail eventually.
Which brings us to the big question, right? If you can't just buy some system off the shelf and expect it to work forever, what are the pros doing that's so different? How do they manage to adapt and consistently find an edge? But we have to bust a huge myth right off the bat. This idea that you could just find some perfect combination of indicators in your trading software, it's mostly an illusion. And why is that? It's simple. Thousands of other traders have the exact same tools you do.
And that's really the key here. The real edge isn't some secret formula, it's the foundation. It's a proprietary, custom-built software infrastructure. Think about it like building your own unique microscope to see the market in a way that literally nobody else can.
Okay, so if that's the goal, how do you actually forge that technical edge? Well, it's not just one thing. It's a combination of three key pillars that come together to create this powerful custom infrastructure. Let's break them down.
So it really comes down to these three core pieces. First, you've got custom data visualization, which helps you see a stock's unique behavior. Then there's data mining, which is all about finding hidden relationships between different things. And finally, statistical analysis to really nail down your risk and spot opportunities. We're going to dig into each of these.
All right, let's really dig into that first piece, data visualization. Now, we're not talking about the standard charts everyone has. We're talking about creating custom views that reveal the deep underlying character, the personality, if you will, of a stock. Okay, just look at the difference here. On the left, you've got Toyota. See how those dots are just scattered all over the map? That plot shows its daily price change versus its volatility, and that messy pattern means it's unpredictable. But then, look at IBM on the right. Those data points are clustered so tightly along that line. That's the visual signature of stable, predictable behavior.
So what does that well-behaved label actually mean for you as a trader? Well, it means the stock's price movements are smooth and consistent, and that's absolutely crucial, especially for an options trader. When everyone can kind of agree on the risk, you get tighter bid-ask spreads and way more liquidity. You can actually see the stability right there in that chart.
All right, now this next part, this is the real secret sauce, data mining. This is where you're not just reacting, you're proactively hunting for relationships in the market that most people just can't see, especially because these relationships can pop up and disappear incredibly fast.
And this is so important. The market isn't some static puzzle you solve once. Think of it more like a living, breathing thing. A correlation that was making you money last month might be totally useless today. That's exactly why you need to be constantly mining the data. I mean, check this out for a perfect example. The chart on top shows this beautiful, predictable relationship between gold and gold stocks for a whole 7 months. You could have built a great strategy around that. But then, bam. Look at the next 7 months on the bottom. That relationship? Gone. It's just a random cloud of dots. The edge completely vanished.
But here's the cool part. It cuts both ways. Just as old relationships die, new ones can appear out of nowhere. In early 2007, this really powerful and super unusual correlation just showed up. The S&P 500, gold, and the Japanese yen
all started moving together. For anyone running data mining tools, this was like a giant flashing red light.
So what was the story here? What was the data actually screaming? Well, it was showing the unwind of something called the yen carry trade. Basically, big investors had been borrowing money super cheap in Japanese yen to buy other stuff. Now they were in a panic, selling everything, including gold, to pay back those loans. This is why gold, the ultimate safe haven, was suddenly falling right alongside the stock market. An insight like that is pure gold.
So we've seen the cool stuff these tools can find, but what's the actual engine look like? Let's pop the hood for a second and see what's powering all these discoveries.
Okay, I know this looks kind of complicated, but the idea is actually pretty simple. It's an assembly line for insights. You pull in raw data, you clean it up, you run your analysis, and then you push the results out to be visualized or modeled. It's just a really rigorous, engineered way to create clarity out of all that market noise.
And just to show you what can pop out of a system like this, look at this chart. Super simple, but really powerful. This just shows the average size of the S&P 500's price move for each day of the week over 1,000 days. And you can clearly see a pattern. Tuesdays and Wednesdays tend to have bigger moves than Mondays. It's a small insight, sure, but when you start stacking hundreds of these little statistical edges on top of each other, that's how you build a real advantage.
Okay, so let's zoom out. What does all this actually mean? Because this isn't just some fringe strategy anymore. This whole technological approach has completely rewritten the rules of the game.
And this, right here, is probably the most important takeaway from this whole thing. Wall Street isn't just a world of traders with good instincts anymore. It has morphed into a massive, sophisticated software development industry. Today, the quality of your software, your code, your data, that's what truly defines your edge.
You want proof? Look at this number. Just between 2000 and 2006, algorithmic trading went from being just 5% of the US stock market to over 27% of the total volume. That's not just growth. That is a seismic shift in how markets work.
But here's the kicker, and it's actually really good news. The cost of computing power has just fallen off a cliff. The kind of system that would have been exclusive to a giant hedge fund just a few years ago is now totally within reach for a dedicated private investor. What this means is that the playing field, it's really starting to level out. If you're a private investor with the right skills and a systematic approach, you can now build the kind of analytical horsepower that was once reserved only for the biggest players on Wall Street.
So I'll just leave you with this question to think about. In a market that's more and more dominated by these custom-built algorithms and analytical engines, what's the real risk? Is it trying to build one for yourself? Or is the biggest risk of all not even being in the game?